Hi there, welcome to this revision video looking at how we calculate the revenue of a firm. So what is revenue? Well, revenue is basically defined as the income that's generated from the sale of goods and services in a market. It's also known as turnover, or just simply the value of sales. We make a distinction between three main revenue concepts. First of all, average revenue, which is just the price per unit, expressed as total revenue divided by output. And the average revenue curve is essentially just the same as the demand curve. Marginal revenue is the change in revenue from selling one extra unit of output. And total revenue, or TR for short, is the price per unit multiplied by the quantity. So these three revenue concepts will come into play as we looked at a worked example. Before we do that, here's a chart showing the largest businesses by revenue in the world. And take a look at the types of businesses there. It's dominated by oil companies, by giant retailers, by telecoms and by car makers. These firms generate hundreds of billions of dollars of revenue each year. Let's have a look at how we do some simple revenue calculations. And we'll take as our starting point the idea of a falling demand curve, AR sloping downwards. So our price is falling in units of £2 and the quantity demanded is rising by 50 units for every price fall. If we multiply the average revenue, price per unit, by demand, we get total revenue, and at £20 our revenue is 4,000. What happens if we reduce the price to 18? Well, demand goes up to 250. Multiply those two numbers together, we get revenue of 4,500. So clearly the firm has benefited in revenue terms from cutting the price. But if the price falls to £16 per unit, yes, total revenue goes up, but notice here it's rising at a decreasing rate. We're only gaining £300 of revenue for the extra 50 units sold. Revenue rises still further when we cut the price to 14, but again notice here we're only gaining £100 for those extra 50 units. And if we lower the price to £12 per unit, total revenue actually starts to falls by £100. If we keep this going through the following price changes, you'll see that revenue keeps falling until we get back to £4,000 of total revenue when the price is £8 and demand is 500. So total revenue rises then falls beyond a certain point. What about marginal revenue? Well, marginal is the change in revenue from selling one extra unit. Of course, in this table, where the change in demand is in units of 50. So we have to divide the change in column 3 by 50 to get the marginal revenue. So the marginal revenue is £10 for each of the 50 units extra sold when the price is cut from 20 to 18. And notice that if we cut the price to £16, we sell an extra 50 units, our revenue goes up by £300, and that means the marginal revenue is 6. Do you see here that the marginal revenue is declining quite steeply, and it's falling more steeply than is average revenue? It falls to £2 when we cut the price to 14, and we know that total revenue is going to fall to 4,800 if we lower the price by another £2. And indeed, if we do the calculation, we see that marginal revenue becomes -2, then -6 and -10. So total revenue rises at a decreasing rate, then starts to fall. Marginal revenue initially is positive, but eventually becomes negative. Here's an example of average revenue in the mobile phone sector for quarterly data from 2012 through to the end of 2013 and 2014. And you can see that the average monthly revenue per subscriber in the UK is around £15 per person. I wonder if you pay a little less or a little bit more than that. But that's a good idea of average revenue. So how does this all turn into a diagram? Here's our downward sloping average revenue curve. Start off with a price P1. We cut the price to P2. Quantity expands to Q2. And hopefully you can see that revenue will have increased there. That area is bigger. The marginal revenue is positive, but the slope is more steep than the average revenue. And if we cut the price from P3 to P4, from P3 here down to P4, we find that total revenue will have fallen because firms are getting a lower price per unit and they're only selling a few extra units. The marginal revenue here will have become negative. So in the exam, when you're drawing an average and a marginal revenue curve, just remember that the marginal revenue curve is half the average revenue curve with twice the gradient. In other words, it will cut the x-axis at a point halfway along from where the average revenue will cut the x-axis. If you draw it this way in the exam, you won't go wrong. You're not expected to prove this, but you just have to be expected to draw it accurately. There's our little guide. MR cuts the x-axis at half the distance from where AR cuts the x-axis. So this has been a little look at average and marginal revenue. If a business wants to maximize their revenue, they choose an output where marginal revenue is 0. And you don't have to prove this, but this is at the midpoint of any downward sloping demand curve. That's been a quick look at how we calculate the revenue of a firm.